Before you watch the video on how to prepare a statement of cash flows for flip and flops, you want to go out and print out the activity. The activity will be at the bottom of the screen where you found the link to this video, and it also can be found under the Many Cases and Activities tab on the statement on Blackboard. All right, before we get started on actually preparing the statement of cash flow, let's talk a little bit about it. The statement of cash flow has three major sections: the operating section, the investing section, and the financing section. And if you think about it, these are the three major activities of any company. The first one is, here's what we do. The operating section is going to measure, here's what we do as a business. Here are our operations. So, for example, in flip and flops, they make flip-flops. And so this would be, we would want to see how much cash flow they make from making and selling flip-flops. The investing section is primarily related to investing activities. It can relate to in making investments in stocks and bonds and that types of things. Those do flow into the investing section, but it primarily relates to the company investing in itself. For example, the purchase of equipment. Okay, so the purchase of equipment, because it's going to invest, these investments in equipment help the company then generate income from operations, from cash from operations. Okay, and then the last piece is financing, and this is, where does the money come from? Where do we get our investments to purchase? Where do we get cash to purchase these investments, which then can generate, which help us with our operating activities? So these are the three major sections, and actually the three major operating activities of any company. One thing to think about here, one little point is that the operating section, when we prepare it, the first line item is always net income. Okay, so if we want to write net income, it's always the starting point. The next line item is always going to be adjustments for non-cash expenses. And in our case, our primary non-cash expense we're going to be looking at is depreciation. There are all sorts of other non-cash expenses that can come into here, but the big one is always depreciation expense, because it is non-cash expense. And all the other adjustments then, if we could categorize them looking at the balance sheet, we're looking at changes in short-term assets and short-term liabilities. And when I talk about changes in short-term assets, I want to say everything except cash, because that's what we're reconciling to. Cashes are going to be our bottom line result in the statement of cash flows. So we'll look at all the short-term asset accounts except the statement of cash flows. All right. When we take into account these elements, I'm going to give you a little rule of thumb, and we can talk about it in class a little bit more. But when you look at changes for on the asset side, always do beginning minus ending. And if you do that and keep it in that order, and put the right sign on the number, exactly the number you get out of the financial statements, if you do beginning minus ending, you'll come up with a number here. And the sign on that number, whether it's positive or negative, will tell you whether it's a positive cash flow and should be a positive number in the statement of cash flows, or a negative. And you'll see that a little bit when we go through it. On the liability side, if you do ending minus beginning on your short terms, you will then, again, come up with a number. And if you keep everything right, it will give you the right sign, whether it's a positive or negative, so you can put that into the statement of cash flows. Okay, so if the operating section is looking at short-term assets and short-term liabilities, the investing side is primarily looking at long-term assets. So any changes in long-term assets are going to be included in the investing section. And last but not least, the financing. Well, what are our two main sources of financing? Long-term liabilities. So long-term liabilities and equity. So any changes in the long-term liability accounts or any changes in the equity accounts are going to come into the financing side. Also keep in mind, again, this whole idea of long-term assets, if we keep in mind this beginning minus ending, when we're looking at long-term assets, it will always give us the right sign. And for long-term liabilities and equity, if we keep in mind this ending minus beginning, it will always give us a number with the correct sign. And again, you'll see that as we go through the process. All right, so with that in mind, let's go ahead and complete the statement of cash flow for flip and flops. So we will always start out by putting the company name, flip and flops. I'm going to put it really small because I don't want to run out of room down here. And it's the statement of cash flow. And like the income statement, since it's a measuring of period of time, it's for the year ending. And we're going to say this is December 31st, 2011. So if I'm going to start with operations, the first line item is going to be net income. And we look at flip and flops, and our net income is $30. The next piece is the changes in depreciation expense. And one thing I want you to notice, I'm going to do a little work over here. If I look at my asset side, remember what I did on my asset side. So if I looked at my beginning accumulated depreciation, I'm just going to label it accumulated depreciation as A/D. If I look at my beginning accumulated depreciation as negative 510 and my ending accumulated depreciation as a negative 570, a negative 510 minus a minus 570, the change in accumulated depreciation in this case is a positive 60. Okay, and in this case you can actually see that our depreciation expense on the income statement was $60, so those two numbers tie out. And so I'm going to put accumulated depreciation, and I'm going to put in a 60, and I'm going to make it a positive number because it's a positive adjustment. Okay. Next, I'm going to look at some of my other balance sheet accounts. I'm going to ignore cash because that's the account we're reconciling to. Look at accounts receivable. Accounts receivable, so I have my beginning accounts receivable, beginning AR, 190. My ending AR is 240. Subtract those out, and that is a negative 50. So for my change in accounts, so my change, I'm just going to put a delta here, change in accounts receivable is a negative 50. Okay. The next, I have one more short-term asset account, and that is inventory. So if I have a beginning inventory of 205 and an ending inventory of 150, subtract those two numbers out, I get 55. And again, you see that this one comes up a positive. So if I put my change in inventory it's going to be a positive 55 in this adjustment in the operating section. Okay, so the operating section includes both short-term assets and short-term liabilities. So since I've got all the short-term assets, look at the short-term liabilities. The first one I see is accounts payable. So if I look at beginning accounts payable, that number, oh, excuse me, we don't start with beginning accounts payable, right? Remember, when we get to the liability side, we flip it. And we start with the ending accounts payable. And the ending accounts payable is 120. And now we do the beginning accounts payable. And that's 100. We subtract that from the ending, beginning from the ending. And our change in accounts payable is a positive 20. So our change in accounts payable is 20. And then we're going to look at wages payable. Our changes in wages payable is, so if we look at ending wages payable, and ending wages payable is 50, and beginning wages payable is 90. So 50 minus 90, I believe, is a negative 40. So my change in wages payable is a negative 40. And with that now, I believe I have all the net income, the adjustment for accumulated depreciation, and all the short-term accounts. So I am now going to put a total on this, and this is cash from operations. And the amount of cash from operations, if I add all these up, I believe is $75. Okay. The next section is my investing section. That's the next major section in the statement of cash flow. And if this investing section primarily deals with long-term assets, I only have one long-term asset, and that's fixed assets. We talked about on the asset side, it's always beginning minus ending. So if I look at my beginning fixed assets are 675. My ending fixed assets are 710. And so that difference then is, I believe, a negative 35. And if you think about that, that makes sense. I mean, our fixed assets went up, which implies we purchased more fixed assets, right? So our change in fixed assets is a negative 35. So cash from investing is a negative 35. And that's now the $75 was a source of cash because it's a positive. Now this is a use of cash. So a company's investing in itself. And actually, we want to see this. Companies that are growing will always be investing in themselves and growing that way. So that is important to see. What we get worried about is if we see a positive number here and a company's kind of liquidating its assets. That can be a concern if they're doing that year after year after year. All right, so the final section then we're looking at, the final section is the financing section. And the financing section, remember, we're looking at long-term liabilities and the equity section. So we only have one long-term liability. And remember, we flip it when we think about the liabilities and equity side. So we look at ending long-term liabilities or long-term bonds, and that is 145. And we're going to look minus the beginning long-term liabilities. We're going to subtract that out. That was 180. So if I subtract out those two numbers, that's a negative 35. So change in long-term liabilities, it's a negative 35. And if you think, again, if you think about it and look at that, long-term liabilities went down, which means they paid off some of their long-term liabilities. How do you pay off your long-term liabilities? You pay them off with cash. And then the only other account we're going to look at is common stock. So we're going to look at the change in the common stock account. And the change in the common stock account, so if we look at ending common stock, that balance is 125, and beginning common stock was 105. Subtract that out from 125, and we have a change on that of $20. So our change in common stock is $20, and that's a positive number. So my cash from financing the total is a negative 15. All right, so let's start putting the pieces. So our total change in cash, is, if I add it all up, a positive 15, negative 35, another negative 13. Our total change in cash is a positive $25. Now I'm going to put a little section in here. If I had more room, it would be easy to see. So if we got our total change in cash, was 25. We would then put beginning cash, our beginning cash number. And if we look at our balance sheet, our beginning cash number was 35. Add these two numbers together. I should take the dollar signs off these because, again, we're not at the bottom of our statement of cash flows. Add these two numbers together, and I believe that should equal our ending cash. And if I add them together, it's $60. And lo and behold, we look at our balance sheet, and our ending cash is $60. Now, one last thing before we're done here. You will notice I ignored retained earnings in this computation. I ignore retained earnings because the change in retained earnings generally is net income. So, for example, if you look at retained earnings here, it started at 120, went up to 150. The difference, the change in retained earnings, is $30. And you can see that is exactly the amount I have in net income. So I've already taken into account the change in retained earnings when I took into account net income. In future videos with regard to statement of cash flows, that might not always be the case, but it is here. All right, so I hope that helped you work through a statement of cash flows, at least a simple one.